This is level 1 of the CFA program, the topic on equity investments and the reading on market efficiency. Let me focus on that word efficiency here for just a second. I bet you're used to thinking of efficiency perhaps in the terminology that you learned in your undergraduate economics days, or even in the readings here in level 1 on efficiency. And so let me give you two examples, one personal and one from industry. So those of you who watch my videos know that I love to talk about my children. I have 3 sons who've taken turns cutting the grass over the years. And back in the days when we had a push mower, I would have them cut the front yard, and clearly they were going like this. They could not push the mower in a straight line. And so afterwards, I'd have to say, dude, look at all these things that you missed, so go back and fix it. This was clearly an inefficient lawn mowing model. Now, an even better example is consider a firm that specializes in bottling some product, whether it's a lotion or soda pop or beer, and an engineer comes in, and an engineer can look and determine how that product flows through the manufacturing facility and make a judgment on its efficiency or its inefficiency. And so what I want to emphasize is the term market efficiency in this context is not really related to the lawn mowing or the bottling company. It's entirely an informational efficiency concept. And Eugene Fama, who is regularly referred to as a father of modern finance, developed this efficient markets hypothesis all the way back in 1970. And he really made 2 contributions. And I want to focus on those 2 contributions before we get into the LOSs so that you get a sense of the tremendous contribution that Eugene Fama made to our understanding of finance and what goes on the floor of the New York Stock Exchange. Eugene Fama quite simply said something like, you know what? Asset prices, like a share of stock, depends on relevant information. In other words, what individuals and institutions are willing to pay for a share of stock depends on the input variables that go into making the core value of a publicly held company. And you can easily divide these 2 pieces of information into general economic information and information that is unique or specific to each firm. So let me repeat that. Eugene Fama simply said that stock prices are a function of all relevant pieces of information out there. And then the second contribution that Fama made was the simple application of this hypothesis to its testability. Like, for example, I could develop a null hypothesis that says something like, my son, when he pushes the lawnmower, is going to push it around like this. So my null hypothesis is that my son mows the lawn in a straight line. My alternative hypothesis will be that he doesn't. And I really don't even need to collect a sample and go out and watch him do this hundreds of times. I just know, based on history, that he is not going to mow in a straight line. But Eugene Fama, this market efficiency hypothesis was super easy to apply because all we have to do is observe stock prices, or more specifically stock returns, and then let's watch out for a change in information. And the most dramatic example of all of these is the announcement of a takeover. So you have a target firm that's trading at, let's say, $100 a share, and you have this acquiring firm that comes in and offers, let's say, $150 a share. Well, that's new information. We have a new bidder. We have a new value associated with this target firm stock. So what happens to the price of that target firm? Is it going to stay at 100? Well, if it stays at 100, then everything that Eugene Fama wrote about is completely worthless. But of course, that stock price in the target firm is going to rise, and it's going to rise maybe all the way to 150, maybe a little bit below, maybe a little bit above. We'll talk at length about that in future readings. But you see the beauty of this. You can easily test Eugene Fama's market efficient hypothesis. And by the way, Eugene was a Nobel Prize winner in economics in 2013. And so I encourage you to actually do a search for his article from 1970 and just read the first couple of pages. I promise you, when you read this, you'll think to yourself, boy, there are people out there who are a lot smarter than I am. And that's what I always thought when I read these articles. All right, let's go into the LOSs. So what do we have? That first LOS. Clearly that's the most important LOS. Describe market efficiency. Then couple that with the fourth one, weak form, semi-strong, and strong form market efficiencies. Those two are going to be prime topics for exam questions. We'll spend a little bit of time talking about the differences between market and intrinsic value, and then skip down to the application of market efficiency in terms of how we, as good financial analysts, want to use all of this information. And what we're going to do is we're going to use fundamental or technical or active management. And then we'll go ahead and finish with a conversation on some pockets of inefficiency, which the academic world has identified as market anomalies. And then we'll have a fairly brief discussion on behavioral finance. And I say brief because we're going to have a much deeper conversation in at least level 2 and perhaps even in level 3 on behavioral finance. All right, so let's start with a simple review of what I said. Right? Market efficiency describes the extent to which available information. So what word did I use earlier? I used the term relevant information. So what's relevant? A piece of relevant information for a company like Johnson & Johnson? Well, information that's unique to Johnson & Johnson would be its product lines, those product lines' ability to generate cash flows, the quality of its board of directors and its chief executive officer, its dividends, all that stuff that we talk about inside of the CFA program. But also, we have information that's general to the economy, like inflation and interest rates and oil prices and anything else that you can think of in terms of one of those macroeconomic variables. So notice what I said earlier. I said relevant information, and that's true, but Eugene Fama emphasized that this is available information. So it's relevant and available information to all people who are standing either in or outside of the floor of the New York Stock Exchange. And so an efficient market is one in which the prices reflect all relevant and publicly available information. And so an efficient market then has to be a market like the floor of the New York Stock Exchange that reflects all of that relevant and publicly available information. I mean, you can't imagine that on the floor of the New York Stock Exchange, if in fact everyone's trading and everyone's happy, and all of a sudden there's an announcement that says something like, oh, the Fed decided today that interest rates are way too high. We're going to cut interest rates by 100 basis points. You can't imagine the traders on the floor of the New York Stock Exchange just yawning and saying, oh, that's dull information. We don't care about any of that stuff. Of course, it becomes available and it's relevant, and then the traders, they rush to try to find new positions. Now, one of the geniuses of Eugene Fama's hypothesis back in 1970 was that he split the groups of information into 3 types of categories. The first group is the group that includes what I think of as like almost all relevant information at its simplest possible level. So if you think about today's stock price, what do you think is the best predictor of today's stock price? And you might want to talk about some of the things that I mentioned earlier, but if you only had a second to come up with that answer, boy, you don't have time to pore through financial statements like we did in all those series of readings. You don't have time to pore over the Wall Street Journal. You don't have time to interview the board of directors and the executive leadership team. But what you do have time to do is whip out your phone and say, oh, the stock price yesterday was 99. That's the best estimate of today's price. So notice in the red there, we have past or historical information. All right, so the first level of information is based on past information. And then what we do is we keep on expanding it. We say all publicly available information, which are things like dividends and mergers and acquisitions and inflation. And then we squeeze that down to include private information, which includes and is not quite limited to, but it gives candidates a pretty good idea of what private information is think about being on the board of directors and you're discussing really, really important things, like maybe taking over another company. And so at the end of the meeting, you say something like, okay, we're deciding to take over this other company. That's private information. That takeover firm's stock price does not yet reflect that private information. All right, a couple of other things here with this LOS describing efficiency and related concepts. So in an efficient market, new information is quickly absorbed. I remember my professor in graduate school snapping his fingers. He said, look, it's got to be instantaneous, because if it's not, then somebody out there is losing money, whether it's an institutional investor or the designated market maker on the floor of the New York Stock Exchange. And as you know, individuals and institutions, they're not really in the business of losing money. Look at that second arrow point. This is really cool. Superior risk-adjusted returns are not achievable. So let me give you the illustration that I teach my students. I say something like this. I say, look, if you're going to take this much risk, and let's assume that there's a one-to-one relationship between risk and expected return. If you're going to take this much risk, then you ought to expect this much return. Now, risk-adjusted superior returns is a scenario in which you take this much risk and you expect to get this much of a return. And so that second arrow point is really important. It says that those returns are not achievable because all of the relevant and publicly available information is already reflected in stock prices or asset prices, which means that if you have information and you think it's new, by the time you run to the floor of the New York Stock Exchange, you're too late. And that's what that second arrow point is really based on, is that as soon as there's new information, there's somebody who's faster than you, somebody who's stronger than you, somebody who's smarter than you. And I mean me too. I'm not just pointing my fingers at all of you candidates out there. There's somebody smarter and quicker and faster than all of us who's going to beat us to the front of the line. And when they get to the front of the line, they're going to make trades, and the designated market maker on the floor of the New York Stock Exchange is going to adjust the price based on that first person in line. Now, of course, it doesn't really actually work that way. You don't have to run fast. But, we have computers and we have algorithms and we have all these kinds of things in which orders can be executed pretty quickly, as you know. Now, the other part here, look at this, look at the fourth one there, because I want to emphasize about these quickly absorbed and in relationship to how stock prices react instantaneously. What has to happen is that this new information has to come to the marketplace in a random fashion. You can't say something like, okay, I'm going to announce a dividend increase right now, and then investors can anticipate that in 5 seconds another company is going to announce another dividend increase, and another and another and another. So that's the independent from other news and in a random fashion. And then that third arrow point, there are a large number of investors analyze and value securities for profit. What was the line in that old time movie? I mean, I was in college back when that first Wall Street movie came out. Greed is good. And so you have all of these investors and traders out there who are searching for profit, and which means they're searching for an advantage. But in the end, I'm not quite sure if they ever have an advantage. We'll talk about that in later readings, but we'll address it a little bit in this slide deck. So look at the blue arrow point down at the bottom. In a highly efficient market, passive management. Now, passive management just means, let's go out and buy the S&P 500 index fund. Passive management is preferred to active management, mostly because prices are already reflective of any information that an active manager can uncover, but also because of those lower costs of trading. And so, boy, we'll talk at length about this as we go through the program. Which one of those two is wins out in the end? Boy, depending on what day of the week, it probably will determine what that answer is. But they're pretty close. All right, look at this illustration. Notice there's a blue line that's, kind of upward sloping. We call that intrinsic value. I want you to think of intrinsic value as the core value of a publicly held company. And we'll learn in level 2 from these two guys in 1958. They came up with what's known as the capital structure irrelevance propositions. And these two guys' names were Modigliani and Miller. And what they said was, look, forget about all this other stuff. The intrinsic value, the core value, the complete value, the almost total value of a company is based on two things: the ability of the asset to generate large and sustainable cash flows, and its weighted average cost of capital. So think of intrinsic value as kind of like a fundamental value. I look at it as I see my role as a father and as a husband. What is my fundamental value? I guess I'm looking into my soul. I'm not really looking at my hair. Of course, I don't want to look at my hair. I'm not looking at my height or any of that other thing. Maybe part of it is my brain, but what's in my heart? What's in my soul? That's kind of an intrinsic value, a fundamental value. But let's go ahead and extend that to an accounting definition and maybe an economics definition, but clearly a Eugene Fama definition. And it's written right there: value that would be placed by investors if they had a complete understanding of the asset's investment characteristics. Okay, so that's really a strong kind of an assumption. But look at it this way. Boy, if you could look into my heart and soul, you could get the sense of, what kind of a father and what kind of a husband that I want to be. Yeah, so keep those two in mind. The intrinsic value is really the true fundamental value. But market values are prices that investors out there are willing to pay or are willing to sell their shares for. And so clearly, intrinsic value and market value, a lot of times they're the same number, but a lot of times they're not. One is going to be above the other. And so that's where we get into this concept of stocks that are overvalued and stocks that are undervalued. And so look, the red up there at the top, you can see overvalued, where the price is above its true fundamental economic value. We call that an overvalued stock. And then, of course, when the red line dips below the blue line, we call that undervalued. And so this is really one of our roles as good financial analysts, is to try to find over and undervalued shares of stock and bonds and other kinds of securities out there for our clients. Now, what Eugene Fama is telling us is that this is super hard to do. Look at that last bullet point. If investors believe a market is highly efficient, they will usually accept market prices are equal to intrinsic values. So here's the kind of the dichotomy or maybe the discontinuity of what we're trying to do here. Eugene Fama says, look, you're wasting your time trying to figure out all this information because stock prices reflect all relevant and publicly available information. But we as good financial analysts, boy, we have the skill set to be able to process this information, perhaps in a little bit of a different way, perhaps in a unique way, so that there are times where we can find overvalued and undervalued stocks at times over the short term. So this is more of kind of a tactical thing as opposed to long-term strategies. How about this LOS? Explain factors that impact or affect a market's efficiency. All right, so market participants and information availability. Let's start with number 2 here. Boy, we just spent, how many readings? Was it 8 or 10 or 12 readings on financial statement analysis where we were poring over balance sheet and income statement and the statement of cash flow. And so what we're doing is we're trying to find stuff that we like, find stuff that we don't like. But notice what's happening here. The more information market participants have, right, the more accurate those market estimates are going to be, which leads to greater market efficiency. So go back up to number one. Boy, if we have tons and tons of investors out there, and if we have tons and tons of investors who are performing their due diligence, then any mispricing, and let me go back and identify that, any overvaluation or undervaluation is going to be short-lived. So what do we have written there? These mispricings disappear quickly. Do they disappear instantaneously? Well, that's an empirical test that we'll probably talk about, not during this slide deck, but some other day. Now, we're also going to learn about this dude named Harry Markowitz, who showed us all the way back in 1952 how to put together an efficient portfolio. Efficiency in that sense was based on the relationship between risk and return. And Harry Markowitz, of course, is another one of these founding fathers of modern portfolio theory. And Harry Markowitz had no restrictions on short selling. He had no restrictions on arbitraging. And so when you put together this efficient frontier or an efficient portfolio, you could pretty much do anything you want. If you wanted to short 1 trillion shares of a company like Twitter, you could do it. Now, of course, there aren't 1 trillion shares outstanding, but you could do all that inside of this framework. And so the reality of life is that there are restrictions out there. So limits to trading, this impedes market efficiency, as does the cost of trying to gather all of this information. So look at that last one down there. Traders incur these costs when trying to detect and exploit market inefficiencies. All right, let's get into really the meat of this particular reading. So what did I tell you? That first reading to find market efficiency, that was important. So we've done all that in a pretty comprehensive form. Now we need to get down to specifics here. So Eugene Fama said something like, hey, let's group data according to private information, publicly available information, which includes private information, and historical data, which includes prices and volume. So think about what that means is that, you're including and you're excluding as you go out. So here, let's start with weak form efficiency. What Eugene Fama said is that a stock market is weak form efficient if the stock prices fully reflect all historical price and trading volume data only. That's a key part there. Now, we're going to talk at length about technical analysis in future reading, but technical analysts simply look for patterns in historical prices to be able to predict future prices. So if there is an historical pattern, then there's likely to be a future pattern. And so here's the example that I give students all the time. I say something like, let's suppose that you form a portfolio and you add a stock to your portfolio anytime that particular stock price experiences 5 consecutive days of increasing stock prices by at least 50 cents. So you go and you just look, all you're doing is looking at historical prices, and you pull out a sample, let's just say it's 30. You pull out a sample of 30 companies in which the last 5 days they've gone up by at least 50 cents, and you put those 30 stocks into a portfolio. Well, Eugene Fama says, if the stock market is at least weak form efficient, then all you're going to do is earn your risk-adjusted return that is expected based on, these little ranges that I gave you earlier, this and this. Yeah, go ahead and look at that very bottom arrow point. Technical analysts, those trading on analysis of historical trading information, they should earn no abnormal returns. So let me go ahead and give you this definition. This is an academic term, an abnormal return. And an abnormal return is also referred to as an excess return. And that simply means that it's a return in excess of the risk that you had taken. In other words, can you use historical data to outperform a similar portfolio? And the answer, according to Eugene Fama, is no. But I want to make sure I emphasize this here. We'll do all this stuff when we look at quantitative methods. Boy, we can look at a time series of returns. We can compute serial correlations to determine if there is a predictable pattern. So look at that table up at the top. For definitional, for just a purely definitional standpoint, weak form efficiency tells us that stock prices reflect only past market data. So then Eugene Fama said, okay, what's the next level? So he didn't want to call it a pretty strong form or super weak form, so he called it semi-strong form. And so all this tells us is that stock prices reflect historical prices and historical volume plus all publicly available information. And so that all publicly available information includes all of the financial statements, everything in the Wall Street Journal or Barron's, anything that you can learn from your wealth manager, anything that's relevant that is publicly available. So think about what's happening. With weak form, all we have are historical prices. But now we're really expanding that information set to include publicly available information. So what do we call that when we use publicly available information to try to identify over or undervalued stocks? We call that fundamental analysis. And so what we're saying here is Eugene Fama suggests that if you form a portfolio based on a strategy of selecting firms based on public information, like dividend yields, you might say, I'm going to select 30 stocks and that all have an increase in their dividend yield of at least 20% over the last 2 months or something like that. So Eugene Fama says, look, if you form that portfolio is going to have this much risk. You're going to have this much expected return, right? So look at the second bullet point. An investor could not earn consistent abnormal returns by acting on new release, public information, surprise announcements, since the market would quickly react to that new information. And then finally, strong form efficiency. So I always think of like the Arnold Schwarzenegger thing here. Strong form efficiency simply tells us that stock prices reflect all public information and all private information. Boy, so what does that mean? That means that if you sat in on all the board meetings that occur, most board meetings occur, or annual meetings, and the board meetings occur at the beginning of the calendar year, those first, February, March, April, and May. If you sat in on all those meetings, you would probably come out with some valuable private information that you could trade and you could earn abnormal returns. So that's what we're saying down. Look at that bottom bullet point. Most research indicates that markets are not strong form efficient because you could probably use that private information to generate an abnormal return. Let me give you the quick example. Years and years ago, the school where I was teaching distributed and developed and delivered its MBA program to local businesses. And one of the businesses was a super large Fortune 500 company. If I told you the 3 letters in its name, you would say, oh, of course, I know that company. But I was teaching once a week. I went up on Wednesday nights. This was over the summertime. And from one Wednesday to the next Wednesday, this company announced that it was taking over a software company. And immediately after the announcement, the stock price of that target company doubled. And so the next Wednesday I came into class and I said to all the MBA students, I said, oh, by the way, thanks for filling me in on that private information that you guys knew about last week. I could have gone and made tons and tons of money this week. Of course, clearly I was not going to do that because that's illegal. But, in the context of an academic setting, I can convey these kinds of thoughts. The MBA students, they all said, oh yeah, these were mid-level managers, and they all said, boy, we didn't know anything about this. And so I said, look, if you knew this and it weren't illegal to trade on private information, what would you have done? And they all said, oh, we would have gone out and bought as much stock in this software company as possible. And I said, no, 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 you would never have done that. You would have gone to the option market and bought call options with super high exercise prices, and then you could have magnified your returns. And it was really a great learning experience. They learned about stock markets, and they learned about option markets, and they learned about strong form efficiency. So clearly that information was valuable. That's why Eugene Fama says something like, look, if the markets are strong form efficient, that you can't use private information to generate an abnormal return. That's the definition of a strong form efficient market. However, we know that that's probably not true, not least of which is the example that I just gave you. So look at that bottom arrow point. Therefore, comma, the need for insider trading laws. Now, I'm guessing that you guys, especially those who are outside of the United States, know that the U.S. has some of the most strict insider trading laws. There are other countries out there that don't really have any insider trading laws. All right, so here's a summary illustration. Weak form efficiency reflects historical prices and volume. Semi-strong form efficiency tells us that prices reflect all relevant and publicly available information. And strong form efficiency tells us that prices reflect all private information and all public information as well. Now, this is what I was telling you in those earlier slides. Here's the great question. Can abnormal returns be earned through some kind of a strategy, assuming different levels of market efficiency? So here's the strategy going across the top row. Can we use technical analysis, which is just looking at historical prices and volumes to try to detect patterns? Fundamental analysis, which is exactly what we're doing in the CFA program, poring over financial statements in the Wall Street Journal and every piece of publicly available news source. And then insider trading, just think about it. Boy, can you sit in on the board of directors who make decisions, and then you would know those decisions before that information became public. And then active portfolio management, that's over there for us, for those of us who are active portfolio managers. All right, so can you use technical analysis to generate an abnormal return? That means that if you take this much risk, you get this much return. You expect this much return, and the answer is no. If you take this much risk, you're going to get this much return. So the answer is no in that column. How about fundamental analysis? Well, if you analyze dividends and mergers and board composition and board skill, and the market is only weak form efficient, well then those prices do not reflect dividends and mergers and all that stuff that I just mentioned. So yes, of course, you ought to be able to dominate. So I want you to think about it in this way. Suppose, for some crazy example, that LeBron James came out to play a basketball game, and he had 4 of his teammates from any one of the teams that he's played on, and he comes out and the opposite team is a group of 10-year-olds. Will LeBron James and his teammates be able to generate abnormal returns? Will they be able to dominate the game? And the answer is yes, because the 10-year-olds are at a disadvantage, size and strength and maturity and all that kind of stuff. So fundamental analysis is a dominating piece of work, because if stock prices only reflect that small information set of historical prices and volume, then you're going to be able to earn abnormal returns. But fundamental analysis does us no good if the market is semi-strong, and it does us no good if the market is strong form efficient, because the prices already reflect. So you think you have a great piece of information. You say, oh, I have some really cool information about the dividend yield on this company. And you run to the New York Stock Exchange and the price already reflects that information that you thought you had and you thought that was going to be valuable. It was valuable and it's already reflected in prices. So it's almost like it's magic. But the magic is based on the Adam Smith invisible hand, and the magic is based on, what did I say in that earlier slide? For profit. Everyone's out there for a profit. And so no one is out there for a loss. And so to prevent the for a loss, then people do everything they can to avoid losses. Now, insider trading, we can still use the same example with LeBron James and the basketball players. So insider trading, of course, is going to allow LeBron to dominate against 10-year-olds. But let's even change the 10-year-olds into 15-year-olds. Insider trading is still going to dominate because LeBron and his teammates, they can beat 10-year-olds and they can beat 15-year-olds. But when the market is strong form efficient, they have to go up against other basketball athletes who are just as big and just as strong and just as fast and just as smart and just as the ability to shoot all of those things. And so, what do they call that? It's a wash. So insider trading does no help if the market is strong form efficient. Now, active portfolio management, boy, what are we saying here? Active portfolio managers will be able to beat the market if it's only weak form efficient for similar reasons and analogies with LeBron, but active portfolio management is not going to be able to beat the market if it's semi-strong or strong form efficiency because prices already reflect. So hopefully that last 10 or 12 or 15 minutes of your time was helpful in giving you guys a good background of explaining market efficiency and then how it relates to these LOSs. All right, so you have to take a deep breath and then ask yourself the question, all right, is the stock market weak? Is it semi-strong? Is it strong? What the heck are you telling us, Jim, here? Is the market perfectly efficient? And the answer is no. I mean, Eugene Fama never used the word perfection in his description of the market. Remember, he was only talking about informational efficiency. And that's really the beauty of what we have been talking about over the last handful of minutes. So the question then becomes, are there inefficiencies that are sustainable? And the answer to that question is probably no. But are there pockets of inefficiency that pop out? You ever play that game when you go to the beach and walk along the boardwalk? What's it called? The whack-a-mole? So I always think about these market anomalies as the whack-a-mole. So you whack the mole on his head and he goes back into the hole and you keep whacking. And so there might be pockets of inefficiency that pop up. But what happens is that these market anomalies cannot remain market anomalies unless they remain over some time period. Now, I'm not saying they are going to exist from now until eternity, but some long time period. And, to define long time period, you have to be able to ask yourself the question, okay, what does that mean in relation to the value and the release and the absolute magnitude of all of these changes in economic information? Things like inflation and energy prices and how they impact stock prices over the long term. All right, so what's said in these teardrop points here? Market anomalies occur when a change in price cannot be directly linked to current relevant information. All right, so that's what I was talking about a pocket of inefficiency. Now, anomalies, they could be the result of data mining or data snooping. I mean, when I went through my doctoral program, we all have to write a dissertation. We all have to do independent research. And so we're collecting samples. And so there's this conversation. Our professor said to us, look, you collect the data. And if the sample is 97, well, then you put 97 in there. And our professor says, don't you dare go in and look at those 97 and pick out 4 that you don't like and throw them out. That's data mining and maybe even data snooping, although data mining, boy, that's really one of those egregious errors that doctoral students could make But I can promise you that I never made that one, or my colleagues, my peer students, we didn't do that for lots of reasons. All right, let's go ahead and work through some examples of market anomalies. So let me give you a little bit of a history lesson here. I was lucky. I was in graduate school from, almost 1990. My PhD is in 1993. And so I went through a doctoral program when these market anomalies were being commonly researched and published. And so we talked about these all the time in our classes, and some of us wrote dissertations that had these kinds of studies. And so these anomalies really were the ideas of a researcher that said something like, well, you know what? I wonder if such and such and such and such has an impact on these stock prices. So one of the first stock market anomalies was this thing known as the January effect. And I bet you guys have heard about this. What the original researchers decided was that if you looked at the returns on a monthly basis, January, February, March, April, right? You have 12 of them. And you collect data for, lots of years, say a decade worth of January and February, etc., all those returns, and you compute things like the average January return and the standard deviation of the January return, and maybe some other statistics out there. What would you expect? I mean, Eugene Fama would say something like, well, there's nothing interesting about any month. So those monthly average returns, they ought to be the same over time. But what the researchers found out is that January had a statistically significant higher return than any of the other months. And so the researchers then scratched their head and said, oh my gosh, this is evidence that Eugene Fama really doesn't know what he's talking about. Comma. Now, Eugene Fama didn't win the Nobel Prize in economics because he didn't or doesn't know what he's talking about. Now, what researchers did subsequent to that is, and this was because data became more readily available, at some point we had monthly data, and then sometime in, 1986 or 88 or somewhere in there, we had access to daily data. And what researchers then found out is that this entire January effect was the result of the first couple of days, maybe 3 or 4 days in January. And so stock prices tend to rise in those first couple of days in January. So what do you think? Okay, well, reasons for the January effect. How about tax loss selling? So you have lots of people who sell their shares at the end of December so that they can have a tax loss on their income tax return for that particular tax year. So they sell them at the end of December, and then they wait a couple of days, however many days according to the laws of the SEC, and then they buy them back in the beginning of January. And so they bump up the January prices in those early days. So there's tax loss selling. And then there's a window dressing down here. Boy, if I'm a wealth manager and I want to window dress my portfolio, maybe I'll do some extra selling in December, and then maybe some extra buying in early January, depending on what the prices are in relation to that week or 10 days worth of trading, just so I can make my portfolio look just a little bit better. And then there are some other explanations out there, not least of which might include something other that's totally unrelated to the month of January. I mean, maybe it just has to do with, I made a New Year's resolution on January 1st, and my New Year's resolution on January 1st is to be more optimistic. And so I'm going to go out and I'm going to buy shares on January 2nd and January 3rd and January 4th. So the optimism impact might have a reason for this market anomaly. So I want to give you the summary here from an academic standpoint. And by the way, this is why I love being a professor, and this is why I love studying, because you get to study, and I mean really study, these researchers like Eugene Fama, and you can learn so much from them if you read these articles over and over again, and then you go and perform their tests. And so we have to be careful about a market anomaly. It can pop up like a whack-a-mole, but sometimes it doesn't persist, but sometimes there's a reasonable explanation that doesn't punch a hole into the efficient markets hypothesis. So I'm pretty sure that not too many think that there's a January effect that ruins the efficient markets hypothesis. Now, how about time series anomalies? These are really cool. In level 2, we're going to do time series regression, and we're going to have to talk about things like autocorrelation, and we're going to talk about things like moving averages and Garch models. Those would be super fun conversations that we have. But for now, let's keep it simple. Look at these two here, time series anomalies. So time series just means that we're going to go ahead and look at a series of prices and see what happens to those as they reflect new information. Okay, so we're looking at historical prices, and then we're saying, okay, on this date, there was good information. On this date, there was bad information. Well, this is what we know. We know that stock prices overreact to good and bad news. In fact, what we know is that stock prices tend to super overreact to bad news, right? When a company cuts its dividend or omits its dividend, what happens? Oh my gosh, the floor drops out. On the New York Stock Exchange. No investor likes a dividend cut or especially a dividend omission. So there is an overreaction. Same thing for good news. If we hear a company has a new product line, we run out and we're optimistic and we buy those shares of stock. So that's overreaction. And the other part is momentum, that if we have a good week, then I bet we're going to have another good week. And then we're going to have another good week. And so you have this momentum. And now remember, momentum can work both ways. You can have positive momentum where prices that are rising are followed by prices that are rising, are followed by prices that are rising solely because prices are rising. That's momentum. And then you can do the same thing on the downward trend. And there are lots and lots of studies about momentum. So there is something to be said about overreaction. There is something to be said about momentum. But there are probably some good explanations for that we'll get into in a future reading. And then there are cross-sectional anomalies where you collect a sample of firms and you cross-sectional use regression analysis. Cross-sectional meaning that you just have a bunch of firms from different time periods that have some commonality. And so how about a size effect? And so what researchers did back in the late 1980s is they said something like, okay, let's collect a sample of small firms and let's collect a sample of large firms. And then let's compare the two returns, right? Small firms, they ought to generate the same return over time that the large firms do. Well, we find out that this is not true. And so there's a size effect. Small companies tend to outperform larger companies. And sometimes this can be done on a risk-adjusted basis. Sometimes it's not. But there is lots and lots of research out there. And we'll talk about this in the future about how you measure size and how you define small cap and large cap, because the definition of those two is going to impact this kind of a study. Now, this part B, this one here is interesting, and there's some merit to this, the value effect. So stocks can have low measures of value, whether we say price to earnings or price to book or price to cash flow, or however we want to define those things. And we can include dividend yields in there. And so what we know is that value stocks, they tend, you ready for this? They tend to outperform growth stocks over long periods of time. And so this anomaly, look at what we have in the bottom there. It contradicts semi-strong market efficiency because, price to earnings, price to book, dividend yields, cash flows, all that stuff is publicly available. So value stocks always outperform. Well, this really crinkles the efficient markets hypothesis. So this value effect has been studied and studied over and over and over again, and not least of which has been done by Eugene Fama himself, which he and one of his co-authors, a dude named French, came up with a really, really cool model that we'll talk about some other day. Other anomalies, closed-end fund. do we even know that there are closed-end mutual funds anymore? I mean, most mutual funds are open-ended, but there are still some closed-end funds, and these things sell at a discount to their net asset value, and they do this. This is persistent and sustainable, and this happens over long time periods. But there's probably some tax associations that can explain this. So I'm not quite sure that the closed-end fund discount is a stock market anomaly, although it might be. Just remember it as another category of an anomaly. And then there's this thing about earning surprises. So think about this. If you have 10 analysts, and the 10 analysts say, oh yeah, let's suppose I have Jim's company, right? Jim's company is going to have these 10 analysts. They have 10 expectations for earnings per share. They say, oh yeah, Jim's going to have an EPS of $5 per share next quarter. And so it comes out that next quarter, and I release all my financial statements, and oh my gosh, it's going to be $8 per share, not $5. So this is an earnings surprise. So what do we know? Stock prices have a tendency to underreact to new information, okay, allowing for a momentum strategy so that earnings surprises could be potentially profitable. So this earnings surprise is really a super general idea about a pocket of inefficiency. So you have to combine momentum, you have to combine a belief that there is underreaction to new information. And think about underreaction as what I was saying earlier in my example when I said, oh, the traders just yawn on this information. And I don't ever believe, in the many times I've been to the New York Stock Exchange and to the Philadelphia Stock Exchange and to the Chicago Mercantile Exchange and the New York Mercantile Exchange, I don't see anybody yawning there. Oh, IPOs, this is fascinating. And so what do we know? An IPO, generally, it burns, right, the first 3 or 4 or 5 days. So if it's offered at $20, after 5 days, all of a sudden it's up to $32 or $37 or some much higher number. And so originally people thought, well, of course, this is an example of a market anomaly, but then notice what we have in that arrow point, incentivized to set a low price. And so there's a couple of other things going on. So this could be an anomaly, maybe not, it's questionable. Prior information, I don't like this one as an anomaly at all. Boy, lots of researchers collect huge samples of firms and then say something like, all right, let's look at the yield on a 10-year treasury, and then let's look at the change in CPI and the change in PPI. Let's take some implied volatility from the options market, and let's do some kind of cash flow yield or a dividend yield. And so they collect tons and tons of information, and this research is super valuable and super important. But what it does is it actually promotes the idea of market efficiency. And so I'm not really sure it's an anomaly. In fact, we even say that down here, not evidence of an anomaly. All right, let's move on to the last section or two of this reading. And I will say that the behavioral finance section in this reading is super small. It's very compact. So I'm going to give you just a little bit more than what is given in this reading. And this is really in preparation for a much more detailed conversation about behavioral finance in future study sessions. So behavioral finance is based on the notion that investors are just normal, regular people. Let me go ahead and explain that. I gave you a couple of names here, right? Harry Markowitz, Modigliani and Miller, William Sharp, Eugene Fama. They all relied on the notion that investors are rational. And rational means something like these investors make decisions based on their level of risk. But it also makes an assumption that these investors are really, really good at processing this information. They process information accurately and completely, which means they do exactly what you and I have done over these last handful of recordings. What did we do? We looked at the balance sheet and the income statement. We did all that stuff. But behavioral finance really got its kickstart around 1990 because of all of these market anomalies that were arising. And so a couple of researchers, some on the west coast of the United States, said, well, maybe investors are not rational. Maybe they're just normal. Sometimes they can be referred to irrational because they suffer from biases. So let me tell you about the biases. So investors are susceptible to making mistakes of the brain. We call those cognitive errors or cognitive biases, and mistakes of the heart. We call those emotional biases. All right. And these emotional attachments to a share of stock, or these faulty brain waves that we have, faulty meaning like, my sons, they can't push the mower in a straight line. It leads to irrational decision making, which may lead to over or underreaction to new information. So this is super important. If you are a behavioral finance believer, then you do not believe Eugene Fama and the efficient markets hypothesis, because you believe that investors are irrational and their decision making is going to be irrational. How about if I use another term? Suboptimal. And those suboptimal decisions are going to push stock prices either a little bit too high or push them just a little bit too low. And then we, as good financial analysts, can jump in and say, aha, you people over there, you're suffering from an emotional attachment to this stock price. Therefore, it's way below its current intrinsic value according to my calculations. So I'm going to label this as an undervalued stock, and I'm going to go ahead and buy it. And then I'm going to make tons of money when everybody else figures out that your your emotional bias has led to inaccurate pricing on the floor of the New York Stock Exchange. And by the way, I think I used the term noise. The great Fisher Black wrote tons and tons of articles. Of course, he would have also won a Nobel Prize in economics had he been alive when they did the option pricing model for the Nobel Prize. But he wrote a super cool article in the Journal of Finance. It's the shortest title in the history of Journal of Finance articles. It was one word. It was called Noise. And in this article, Fisher Black tells us all about noise, meaning irrationality and suboptimality, and how it pushes prices away from their intrinsic values. All right, so that's something that we need to grab a hold of. We need to grab a hold of and say, okay, behavioral finance is going to lead us down a path that is going to allow us to find undervalued and overvalued stocks. Do you remember in one of Tom Brady's multiple Super Bowl wins, somebody asked him in the aftermath of the Super Bowl win, they said something like, hey, Tom, does this make up for that terrible loss in the Super Bowl that you had last year, 2 years ago, to whoever that was, the Giants? How about if I upset all you New York Giants fans? I'm sorry, all you Patriots fans. Didn't the Giants guy catch the ball on top of his helmet? They said, Tom, doesn't this win make up for that loss? And Tom Brady looked at him and said, you're nuts. Are you kidding me? I lay in bed at night. I agonize over that Super Bowl loss. He said, yes, this is great. Absolutely, this is great. But it doesn't make up for the pain that I felt. All right, so loss aversion bias. This simply means that investors have a tendency to dislike losses more than they like comparable gains. In other words, that if an investor is this happy to have a 10% gain, then they should be this sad to have a 10% loss. But instead, they have this much sadness for a 10% loss. So here we go. This is the implication here. Loss aversion bias, right? We dislike losses way more than we like gains. There's asymmetry here. This may help us explain why there might be some underreaction and overreaction, not even just to these anomalies that we described, but also to other stuff, to other information releases that are out there. So think about this. It's the human element that is moving stock prices away from their intrinsic value. It's not because Eugene Fama didn't think about all this stuff. It's the human element, loss aversion bias. How about this one here? There was a study done when I was in graduate school, and it was brought to my attention by one of the management PhD students. Of course, they had to read bunches of articles like we did. And they said, hey, look at this article. It's really fascinating. They interviewed the CEOs of the Fortune 500 companies. And they said, here, we want you to rank us. We want you to rank yourself compared to the other CEOs who you know. And because, CEOs, just like college presidents, they hang out together and they know each other, maybe not too closely, but they have the same kind of problems and the same kind of challenges and opportunities. So they know each other. And so the average self-evaluation of a CEO of these Fortune 500 companies was the 95 percentile. So clearly there's an overconfidence, right? We have a tendency to place higher values on our skill sets than probably is warranted. So then they said, evaluate all your colleagues, and the average was like 35%. So really there's a overconfidence bias. So what does that lead? That leads us to, what did we say a rational investor was? To completely and accurately process all this information. Well, if you're overconfident, you may just say something like, oh, there's a dividend company over there. I know that they're going to do this and this and this, and they're all good things, so let's go ahead and buy their shares, without doing all of the hard work and the due diligence. Look at that last bullet point down there. These mispricings shown to mainly take place in higher growth companies whose prices react slowly to new information. All right. So I'm scratching my head about all this because my professors in college, they were big Chicago fans. And so, they promoted efficient markets hypothesis. And we talked about this in all of our classes. And so anytime we get into an issue with efficient markets, I always have to take a step back. But I will say this, that there is loss aversion, there is overconfidence, and there are other things. Information cascades, this is not too terribly important from my perspective, but the Institute puts it in here. So make sure that you know what this is. But my take on this is that there are pockets of inefficiency. There are, and they are mainly caused by behavioral investors who are out there influencing prices. So an information cascade, what does that mean? We're just rolling down the hill with a snowball and we're collecting snow, and so it gets bigger and bigger. And so if you think about this, let's suppose that I'm a completely uninformed investor and I see, hey, there's good news about this company, and I see the stock price goes up for a couple of days. And then I see all really smart people going to the New York Stock Exchange and they're continuing to bid up the price. So I'm going to decide to buy, not because of the original information, but because all the smart people out there are continuing to buy. So this information cascade, this is probably leading to overreaction. That makes sense if we're going to continue to bid up the price or bid down the price. But there are a couple of things that are at play here in these information cascades. Is that you think about it. If you have a company like Johnson & Johnson or Procter & Gamble or Coca-Cola, are there any secrets in these companies? Mutual fund managers, hedge fund managers, pension fund managers. These really, really smart men and women, many of whom hold the CFA designation. So they've gone through all the work that we're going through. They know everything about Procter & Gamble. So really, is there going to be cascading there? But it's probably going to occur in a company like mine. What did I call myself a minute ago? Jim's company. Maybe I'm a small company. Or maybe my financial statements are not presented according to GAAP, and so you're not really quite sure what my information means. So this information cascade, there's something to it, but it's probably more relevant for Jim's company rather than Procter & Gamble. And then the herding bias, boy, we know this. There's no doubt that there is a herd mentality. And so if everybody is buying one company, then everybody else ought to get in and buy one company. How about this example? Those of you who, maybe not day traders, but those of you who follow important information as it relates to a day-to-day basis, Go back to, what is this? Was it in 2021? GameStop. So what happened with GameStop? GameStop was just a dull company who was just, they sell game consoles and they sell maybe some discs and, whatever they sell in there for PlayStation and GameCube and Xbox and all those things. And all of a sudden, there were some people who said, this company's not very well run. Let's start shorting these shares. So there were tons and tons of short sellers. Then there was a new chief executive, and then everyone bought it, and so the price went from 20 all the way up to 400 something. Then it went down to 140, then back up to 410, and up and down and up and down. And so this was really an example of short-term herding. When everyone was doing one thing, the price was going up, and then everybody was doing another thing, and the price was going down. So herding is probably relevant. However, I'm not quite sure how you can generate abnormal returns based on herding, but let's just hold off on that for a second. So that takes us through all of these learning outcome statements. So let me just remind you, that first one, market efficiency. So that definition. You're clearly going to be able to get those questions right on definitional concepts. But then the second question is the market weak or semi-strong or strong form? So I think you're going to be able to get those. The great question will be, okay, fundamental, technical, active, and passive portfolio management, are you going to be able to generate, those abnormal returns? So look for that term, abnormal returns or excess returns on the exam. And then a little bit on market anomalies and a little bit on behavioral finance. So this was a fun slide deck for me. I could talk about this for hours and hours and hours. So thank you for watching. Have a great day and good luck studying.